All right, everybody. We're going to get this started here in a bit. Give us 1 second here. All right, so just for you guys to know what we are going to be doing today. So we have Mark Petrino, former hedge fund manager, right? This guy's traded with the likes of, well, literally with Steve Cohen, Mario Gabelli, multi-billionaires. We're talking 35 billion and higher. So as a money manager, market maker, Mark Putrino has been around the block. He's definitely done a lot in Wall Street. So we're going to go ahead and bring Mark in here. I just need a quick second to make sure that everything's up and going here. 1 second, folks. Okay, so I believe that we do have Mark Putrino here in the house. Let's just confirm here.
Rodrigo.
Yo, what up, Mark?
Hey, what's going on?
Dude? Not much, man. Class was great today. Very insightful. I always like the approach that you take in the school, which is really a student approach, right? Letting the market tell you what to do, and going over through all the reports that you do. It just seems, I mean, you've been in the markets, you've been a hedge fund manager, you've traded with big folks out there. It's just great that you can share the education, the process, the scheduling, like for traders when they get started.
Yeah, it's pretty wild. It's amazing how many people don't realize you can profit when the market's going down. And some of the students have literally said over the last couple of weeks, like they've had some of their best trading days ever. And even myself, I was watching financial media before, and it seems like the general notion is, well, you got to go to cash, but there are ETFs that go up as the market goes down. So that's where these students have really been doing well, and markets go down faster than they go up. So in a lot of ways, it's easier to profit on the short side of the market. I think, didn't you say that you did well on the S triple Qs not too long ago?
Yes.
Yeah.
I mean, and it's really more like, because here's the thing, in the trading school, you have new traders, and then you have people that might be a little bit more advanced and really just want your guidance and mentorship. And for people that are a little bit more advanced, they just look at your technical levels, right? I mean, you're a chartered market technician as well. You know charts better than anybody. So to me, that's golden.
Yeah, I've been doing this for a while, and you get your moves when important support or resistance levels break, or when markets rebound off of important support or resistance levels. So that's what we look for the trading. And this is our idea of, we let the market tell us what to do. You got to come into each day kind of agnostically and look around and look for things. And, if you see something that's really oversold and it's at a potential support level, well, you keep an eye on it, because if it starts to reverse, you can jump in and get in on the upside. The reason why some of the students did so well is because we had some clear support breaks over the last few weeks, and breaking of the support is what ends up being the trigger to get into the trade.
Right. And there's a lot of things that, look, you have about 8 total chapters in the trading school, Mark, but I think the most important one, right? And it's the most misunderstood, I would say, is the investment psychology, where so many traders come from different backgrounds with different expectations. Some people came in for the meme stocks, other people came from other reasons. More importantly, it's where they're going. But I think that's really why the investment psychology class is a must, because not just the retail side, but also your experience as a former hedge fund manager, market maker, all of that, really what's happening behind the scenes in reality.
Yeah, I mean, the real secret to the success is understanding that psychology. If you look at the market, like right now the market is down about 3%. I mean, that's a huge number. But what has changed since yesterday that would make it go down 3%? Well, actually, there's even more bad news out today. I hate to laugh, but the point is the typical thing that moves markets is investor psychology. Like, why is a stock up 2% on a day where there's no news? Well, it's just because investors' perceptions have changed, and that's psychology. And when we have new students and I ask them, why have you not been successful? It's either, well, I guessed, or I had rules and I didn't stick to them. And both of those are emotional decisions. And both of those will get you into trouble. So, now with this market completely falling apart, people are starting to panic, and there's going to be some kind of flush out coming. And that's when we start thinking about buying stuff. I don't think we're there yet, but investor psychology causes people to panic, and that gives opportunities to other people, like the sell off in the COVID crash, right? I mean, that was a great buying opportunity. The people were panicking. But what happens is when you have an overwhelming amount of investors selling and they're done, there's no sellers left. And the only way the market can go is higher. So that's why you might have heard sell when there's blood in the streets and so forth. But big negative sentiment can be like extreme negative sentiment could actually be a buy signal for that reason. The market effectively runs out of sellers. So there's a lot of negative stuff going on. I just saw how Bob Nardelli, the former head of Home Depot, said you should start stocking up on food. So, that's probably a guy who I would want to listen to. But Rodrigo, if you want, I can just show people some of the stuff we look at that's going on in the market.
Yeah, let's go ahead, share your screen there. And guys, for everybody that's on the Twitter space, keep in mind, we just posted a little thing there on the top of the space. It's a 7-day trial for the Benzinga Trading School. It's a 7-day trial. If you want to keep it after that, it's $14.97 for the year with a laptop and Pro, the research terminal that we use. But that's going to be on the Twitter space. And for you guys on YouTube, it's going to be on the chat. But I think with that, we're good to go, Mark.
All right, so let me just show everyone an example of price levels, how some price levels are more important than others. And sometimes we know why a price level is important and sometimes we don't. But in a lot of ways, looking at these price levels is a matter of market psychology. For example, we have this resistance level up here. This is the triple Qs, the NASDAQ 100. So think about this. Why would this resistance level stay intact or be so clear? Well, people bought up here and then it went lower. And a lot of those people who bought say, hey, I don't want to own this anymore. I'm going to try to get out. So sometimes these resistance levels can stay intact for a while. We have another important level here. And this is an example of where we see a resistance level here converts into a support level here. Now, believe it or not, this comes from seller's remorse. People sell and they watch it go lower and they think that they're, they think they made a good decision, but then the stock ends up going higher and it goes above their selling price. A lot of the people that sold say they want to buy their shares back. They think they made a mistake. So they place their buy orders at the same level they sold at. If there's enough of these buy orders, the level that was resistance can convert into support. So this level is important for this ETF here. We can see here's a resistance level. That's pretty clear. So that brings us to where the most recent place where a bunch of the students did very well on this. We can see here, we have resistance. It became support. Now, when this support started to break, this was the sign that this was going to go lower. All right. When important support or resistance breaks, we tend to get big moves like we see like up here, important support breaks. So this was the sign to get in on the trade. A lot of times trading is it's about patience. It's about being okay with staying on the sidelines and waiting for the market to tell you what to do, because there are going to be, I don't know. I mean, these markets have actually been pretty easy to trade over the last few weeks, but once a month, maybe once a quarter, there's like some really obvious thing that's going to happen. And a lot of times it's okay to stay on the sidelines. And that's part of the whole trading psychology is people over trade. They feel like they always need to be in. They feel like, they have the fear of missing out, right? So anyway, we go back to here. We see this starting to break down. Now there's an ETF that is designed to go up 3 times inversely to this here. So this goes from 304 down to 272. Whatever that percentage is there. about 10%. Look at this ETF here, SQQQ. In the same time, this has gone from 48 up to 65. So it's a significantly, I mean, is it 3 times or is it 2 times? But anyway, it's a significant move. So people, we don't want markets to go down, but we don't really need to fear them. The other thing that we got going on is this big inflation story, which is really like just absolutely ridiculous. And there's a lot of really negative stuff going on in the market. And I mean, we're, I think, really going into some bad economic times ahead here for reasons which I will cover. I would hate to be the bearer of bad news, but it's not me, it's the market telling us what it is. So anyway, so we have this ETF that goes up if the market goes down, and it goes up 3 times the amount because it's leveraged. For people that aren't as risk adverse, because if it goes up 3 times as fast, or 3 times as fast and go down 3 times as fast, there's this particular ETF, which is SH. This is designed to trade inversely to the S&P 500. So we can see here, the S&P 500 is down about 3%. This is up about 3%. And when we talk about inflation, there's a particular ETF that a bunch of the students got into that tracks an inflation basket, right? So a basket of commodities. So while the markets have been melting down, look at this, guys. In the beginning of January to now, it's up 50%. So there are places, there's a lot of ways to make money in these markets, and I think there's some relatively it's been relatively easy because there's just, when there's a lot of volatility, that's when traders really do well. But there's some scary stuff going on. For example, yesterday, Chairman Powell gave his speech, and he said that he sees no signs of an economic slowdown. The very same day, yesterday, the Atlanta branch of the Federal Reserve came out and they reduced their guidance for the GDP to 0. They were at 0.9 last week and they went to 0. So I don't know. I mean, it's really kind of embarrassing, frankly, if you ask the Fed, that it seems like one hand doesn't know what the other hand is doing. The guy who's the boss, the head, comes out and is like, oh, I don't see any signs of inflation. And then an hour later, the Atlanta Fed reduces their guidance. And if they're saying they see 0, it's got to be well below that. So, that's not good. We had this morning.
Really quick, Mark,
Yeah.
before we get into that, just want to ask you something. I saw in the news, I don't know where this is, but that, I don't know if it's in Congress or Senate, I don't know where, but some sort of profit limitation on oil companies. I don't know. Did you see that? Is that?
Yeah, that's just politicians being stupid. I mean, these oil companies had to get money from the government 3 years ago because they were losing billions. We have unfortunately, a bunch of people that don't seem too competent running the show here. And for example, like I just said, Chairman Powell, who said inflation was transitory and who, as of November, was saying everything is fine and rosy right when the market peaked, did he not read the report from the Atlanta part of the bank? How could how could he say there's no signs of a slowdown when part of the bank is reducing their GDP? So unfortunately, all these problems that we have in the world, in my opinion, are driven by our energy policy here. And it's really a shame, but we got some other things going on here too, like this right here. Mortgage rates came out here, and this just shows you how quickly things are changing. All right. So this is the biggest weekly move in history since keeping this. Last week, mortgages were 5.23. They're up to 5.78. They're up like 10% in 1 week, in just 1 week. The Atlanta Fed last week was 0.9% GDP. Now they're like 0. We've had an absolute calamity in the bond market. We could take a look at that here. These are our 10-year yields. And we're up to 3.33. So in a matter of, let me just bring this up here. See, this is, it's not necessarily the absolute change, it's the rate of change. So this is the 10-year yield. It's up 10% in 3 days. You know, so we have these mortgages, we have this, we have the bond market is completely getting demolished. Well, this is the bond market. The chart of a bond would be the inverse of this if you turn this upside down. We're going to have here, this too is going to be a problem, which you're not going to hear people talking about because they probably don't remember if they're too young. But we're going to have what we call a big problem, I think, with chasing performance. So a lot of these pension plans, the people that really run Wall Street, it's not the hedge funds or the money managers, it's the pension plans and the endowments and the people that need money managed for them, are going to be looking at their statements and they're going to say, wow, our bond portfolio is not good. Our stock portfolio is not good. What's been working out? Oh, commodities. Let's go put our money into commodities. So that's going to give us even more inflationary pressure. And that is not going to be a good thing either. So Rodrigo, there's a lot of things out there to really be concerned about.
Yeah, it would just not be, it wouldn't be a good time to just try to wing it, right? And it's not like 2020, everything was going up. Really, at these times, winging it is just, you need to give yourself a chance too, right? Like get a mentor. It's like trying to teach yourself how to, how to become a doctor. It just doesn't work that way.
Yeah. So in addition to working for Mario and for Steve, I was also the head of trading at 3 different institutional money managers where I oversaw the trading. And, we had all kinds of products, hedge funds, boring stuff, exciting stuff, high frequency, deep value. And there's a lot of mythology about technical analysis, right? And I can understand why, because a lot of the technicians that you see don't know what the hell they're doing. Even some of the people that are more well-known, that you might even see on TV. And especially you see it in the retail community. People try to overthink it and they think that this is like some kind of, astrology or tea leaves. It's not. We're just looking at the supply and demand dynamics and we're looking at psychology. Like I showed you before, how levels can turn from support can become resistance like we see here, right? For some reason, this level is important. If you were watching this, you would have got this jump here. Anyway, support becomes resistance. So people think that there's like charting is like, I don't know, like astrology or tea leaves. And it's not. It's about understanding the basic things. So in this school, we cover 8 classes, which are the 8, well, not the 8 fundamentals, but I think the 8 things that are important, right? So the second class, we just talked about how to identify these price levels. We have a class on momentum. We have a class on understanding trends. We have the investment psychology class. We have a class about building models. And here's the thing, the first part of the class, we go through the fundamentals. Like how do you find where there's going to be an important price level, right? Then what we do is we look into the real market in real time and look for that, which is why the students were able to profit when we saw this important level back here break. This is XLK, not the Qs, but the same thing applies. So if you look at like some of these charts, there's like a lot of this like really bizarro stuff here. Like I don't even know what the heck this stuff is. Gann squares, shift pitchfork. No one in the institutional trading world uses this stuff. I don't even know what it is, frankly. Gann, fan, Fibonacci circles. This is, pretty bizarro stuff. So when people start hearing about technical analysis and they start looking at things like that, they just get a a misconception of what it is. They think that somehow if you use this, whatever the hell this is, you're going to be able to figure out how to make money. And I don't know what it is. So anyway, it's just focusing on the fundamentals. Like what are the levels? Oh, important supports breaking. Let's jump in and see if we can make money when it goes down. Important resistance is breaking. Well, let's figure out how we can make money on the way up. There's just some real basic principles that you can, like I've literally have known people have made careers off of. Like when something gets to support and it's oversold, it tends to bounce. When something gets to resistance and it's overbought, it tends to sell off. So I think, Rodrigo, a lot of the students are kind of have an epiphany, or they find it refreshing to see that it's not all this bizarro mumbo jumbo that they might think it is when in sense of reading charts.
Yeah, look, there's a lot of, I guess there's a lot of misinformation out there, a lot of stock gurus. I mean, if you just get into these public forums, the things that people are saying, it's like, look, man, you're going to kill yourself trying to help people out there. You know, but I mean, why is that, Mark? Why do people, all these YouTubers, TikTokers, all that stuff, like,
I don't know. I think it goes back to our psychology. I think when it comes to money, people do irrational things. Like you see people that spend like 2 or 3 weeks, trying to save $100 on, if they're buying a washing machine or a major appliance, but yet they'll see some idea and, like you said, on TikTok or in some chat room, someone they don't even know, and they'll throw $5,000 at it without even thinking. So I don't really know what it is, but when it comes to money, people tend to act illogically. And, that's why we get panic selling. That's why we get euphoric tops that and bubbles that pop. It's people. One of the things I think, Rodrigo, is that, people have, we've evolved, right? We're animals, I guess, and there's this herd mentality that I think a lot of people get sucked into. And I think it's because if you think about it, going back in evolution, right, there was probably safety in numbers. So, it was, you don't want to be alone if you were hunting saber-toothed tigers. You wanted to be with the pack. So I think here's a kind of a funny example, but it's actually quite illustrative, that if you're driving down the highway and you come to a toll booth and there's like 20 lanes, there's a good chance like the vast majority of cars are going to be backed up going into one lane because people just see that line and they feel this natural instinct to like get on line. So that's what they do. But then if you look up around the line, you can see, oh, that lane's open, and you can go drive through those lanes, and then you see other people following you. So the ability to think away from the herd in that simple little example says a lot about the market. If you can, as long as that happens, people that are savvy and are looking at the right things are going to be able to make money in the market, because that's the equivalent of our panic selling when everyone's just throwing in the towel. We see it in a lot of places. But yeah, when it comes to money, people act very irrational. But going back to the class here, right? It's really kind of basically the vision, I guess, would be, like I was, as the head of trading, right? I have to conduct a meeting every morning, and basically we just go through the markets and we just see what's going on, and we look for our opportunities, and we go through the news, and every day might be a little bit different, and we look for stuff. Now look at this is really starting to break down here. So I can almost guarantee you that a lot of the students are gonna be like, oh man, we did so well yesterday, because they're probably buying the S triple Qs or buying options on them. And look at these guys, they're up 12% today. So if someone bought this that close to the open, they'd be up about 10%. And this move higher is coming because we have this support breaking here. So yeah, so that's what we're seeing here. And So, you know, support's breaking. This could lead to another big move. Support's breaking. Support broke, big move. Support broke, big move. Someone is asking me about this stock here, ACOR Therapeutics. So now this shows a big reversal here today off the top. But let's just see if what we can learn about this chart here. So we got up to here and now we reversed. Let's just look at the 1 day. Yeah, a lot of times when you have these news stories come out and something gets really jacked up on the open and opens up high or low, and there's going to be a reversal, it starts to happen around maybe 10 or 10:30 in the morning. So in other words, there's news that's perceived as being really good. But so when the stock opens really high, and let's just say it turns out the news isn't as good as people think, well, that sell-off usually starts to happen around mid-morning. Or if something has what appears to be bad news and it gets really beaten down, but then as it turns out the news isn't as bad as it appears, it tends to start rallying, and that usually starts to happen around mid-morning. So we can see that here. You know, this thing got jacked up on the open, but then right around 10 o'clock, it started to trend lower. So that's a pretty significant move percentage-wise. But that's one of the ways a lot of the students are kind of interested in trading around the news, and that's been my experience. You can't really quantify it, but you'll see the trend start to change, and it tends to happen around mid-morning. So let's see what these guys are all about. Yeah, so you know, just going back to the school, if you understand these basic things, like what are your trends, what are your levels, how to have a little bit of an awareness of market psychology, that is really, you know, I don't want to say it's easy, but it's probably easier than you think if you know what to look at. Like people always say to me, like, oh, Mark, you make these like great market calls, how do you do it? And it's like, I don't. The market tells me right now. You know, the market's telling me we're about to go into or we could be about to go into a big sell-off, because when I look back here, I don't see anything that looks like it's going to be support until we get down to around 355. So that's down about another 3%. So when we saw this level here break, that was the market telling us we were going lower. When we saw after the Fed meeting yesterday, we got above 380, but we reversed. That was some bearish action, and it's fallen through tomorrow or today. So yeah, Rodrigo, I think the big takeaway is to let the market tell you what to do. Don't come into it with any preconceived notions.
Right, and some people might have to maybe unlearn some things, right? Because maybe I feel like the news preconditions people to buy the dip. They're always calling for bottoms every week. You know, this is it for like months and months. And you know, I just feel really bad for the new traders that take it literal. They don't understand that they're just, you know, they're just doing what they're doing, right? You're not supposed to take that literal at all, at any sense.
Well, it's important to remember that the news is really more designed to entertain you than to really teach you. Like, you know what I got on my TV right now? I'm watching the U.S. Open. You know, I don't need to listen to CNBC or you know, I'm listening to the markets. I mean, I think my analysis would really not be that much different if I was, you know, like somewhere like on a tropical island where I could get charts but not news. It's very, very rare that what they're saying in the media is right about why the market is moving. You know, I mean, let's you know, and I can give you all a perfect example. So I understand why people get confused, but this here is when Ukraine broke out, right? The war in Ukraine. So all we heard about was, oh, Ukraine driving the market down. But then we get down to here, and what happens? We rally, but Ukraine is still going on. So I don't think you need to be Sherlock Holmes to think that, gee, maybe this isn't really Ukraine driving the market down. We're trending lower. And what happened? Well, we found a level that was important. It happened. It used to be resistance. It became support. And that told us the whole market was turning around. So we were able to catch this. Up here, we reached a level that had been resistance. Levels that were resistance can stay intact for a while. Look, I mean, look at that, within 50 cents. So break the trend, we come down, we find support around a level where we were support before. So yeah, it's, if you let the market tell you what to do, you're going to be much better off than if you just try to wing it. And you know, people get into trouble, and I can see why. And believe it or not, a lot of people, they get in trouble because they got off to a good start. You know, it's almost better if people lose money, I think, on some of their first trades, because they'll learn that it's, you know, not easy. And if someone, like, look at all these Reddit traders last year that thought they were out, you know, able to out trade all the top hedge funds because they bought one stock and it went up, you know. Yeah, so it's really weird. It's really weird. People will take time to educate themselves about other things, but when it comes to the stock market, they tend not to. I think maybe they just dismiss it as being too mysterious, maybe. But you know, I see in the media, or the, you know, the quote unquote the gurus, we have everything from people who think they're doing a good job and they're trying hard, but they just don't have the market experience. They have backgrounds in journalism. We have people that have only been trading within the last 10 years. So up until now, they've never really seen a bad time. So they just don't have the experience. You know, the rising tide lifts all boats. And then, as we've seen recently, Rodrigo, we have people that are just downright frauds that are willing to publish fake information and rip people off, as we saw with that a former leading trading school, which has been sanctioned by the FTC. So there's a lot of noise out there.
Right. And I mean, there's really no manual out there when people start trading. You know, it's you know, if the brokerage doesn't care if you blow up your account, they're still going to milk you out of money.
Yeah, and it's important to understand too that markets act differently at different times. You know, what goes on in a bull market and what goes on in a bear market is very different. There are different things in play. Like, this is our healthcare spider here, and this is a good example of this. When something is going down, and look how clear the support is here, and look how clear the support is there. Look at where that bottom is. I haven't looked at this in hours, and we had this right here to this level. Yeah, so this move here filled. Anyway, when we have something that gets to support and it makes a really big ripping move like this, that tends to be bullish. If it's during an uptrend, when it gets to resistance, these big moves like this tend to be bearish. So we can see that right here. So that's an important thing to remember. And I think one of the good things about the class is that people can see these techniques and these models and stuff in real time. You know, anyone could write a book. I could have written a book that said, hey, you know, I made this great call in August of 2000 or 2020, and I said this, and look what happened. But this is the real way to learn. You know, it's like, you can, like, if you look at the boxing analogy, you know, it's like you can spend all the time you want working out, lifting weights, running, until you get in the ring with you know, until you get in the ring and actually start boxing. You just don't know what it means to be a boxer, right, Rodrigo? Like, didn't Mike Tyson say everyone's got a plan until they get punched in the face?
Pretty much. And I mean, most people don't have any plans when they start trading, really.
Yeah, the reason why you want to have a plan is because it helps take the emotions out of it. You know, and I'll show you what could be a potential plan, because you don't want to guess, and there's no guarantee that this is going to work. But let's just look at this tech sector here. Now, my guess is this thing really goes into another free fall, and we end up getting down to around this 110 level. So when we look at a trading model or a trading method, I guess you could say, we have a couple things that we look at. We look at what we call the setup. And that's like if you were a racer or running a race or whatever, that's when the say like get ready, get set. That's your setup. And I would say that if XLK gets all the way down to here, it's going to be extremely oversold, meaning it's been really beaten down and it could snap back like a rubber band. So the fact that we're oversold here, let's just pretend it goes like that. The fact that we're oversold and that we get to a support level are two things that tell me, hey, pay attention to this. It's set up. What a trading watch list could be is a bunch of stocks that are set up, meaning looking like they're going to make a big move imminently or in the near term future. But we don't get in until we have what we call a trigger. The trigger is the thing that actually makes you go. It's get ready, get set. The trigger is the go. So I would say this, if this keeps going down, let's just say it trends lower down to here. The setup would be being oversold and at support. The trigger would be if we cross this line, because that could tell us that the downtrend is broken. Now, the third part of trading models is your exit strategy. You need an exit strategy for making a profit, hopefully, and you need an exit strategy for getting out and taking a small loss or even locking in a profit. In other words, if we get down here and we cross this downtrend line, that would be the trigger. Now, what would be our target for a profit? Well, I would say around 126. The level that was support is there's a good chance it becomes resistance. People buy here, and assuming they held it, if it goes lower, now a lot of the people that bought it back here are experiencing buyer's remorse because the price is lower. They bought it around 126 and now it's around 123. So a lot of these people are going to say, I made a mistake. I want to sell this, but I don't want to take a loss. So I'm going to try to sell it at the same price that I bought it at. So there's going to be there's probably going to be a good amount of sell orders in here. So that would be my target. Now, when we get into the trade, my stop out strategy would be to just stay within it as long as it's above this trend line. And if we start to break the trend line, well, then we get out. So just say theoretically you bought it at 112 and you think it's going to go to 126. Okay. But just say hypothetically we get up here and it goes and it starts to roll over again. Well, then you would sell around 117. So it's not as good of a profit as it would have been, but you would lock in your profit. So it's easy to buy things. People buy a new stock and it's like they got a new friend, or it's like they're going on a date or something. They have a new chance to make money. They got a new thing to follow. But when it comes time to sell, it's a whole different ballgame. What was it? What the place that said the other day, like they're never going to sell their Bitcoin? It's like, well, what's the point of buying it then if you're never going to sell it? So you're just going to have it on paper. But anyway, so these are things that we talk about in our trading models and strategy, investment strategy class, which was actually today. So we want to have our setup, right? The get ready, get set. We want to have the trigger, which is actually go buy the stock. And then we want to know how we're going to get out of it. You shouldn't get into something if you don't know how you are going to get out of it. But again, this goes back to letting the market tell us what to do. We're not guessing, just pulling a random number out of the air. Oh, if it gets to 110, I'm going to buy it. We're thinking about buying it around 110 because it was support before, and levels that were support can remain intact for a while. And we could see that here. So I think, Rodrigo, a lot of people, they come into it just guessing, and the class teaches how to help them not do that anymore. And, there's no guarantee, but it stacks the odds in your favor.
What do you think would be a good message, Mark, for all the new traders that are coming in, looking at the markets, trying to make money, obviously, just like it was in 2020, right? If they, one thing you could just tell them, they could help them.
Well, I mean, I gotta, I gotta talk about this for hours, but uh, well, you have to understand why you're making mistakes. And I can almost guarantee you, if you're making mistakes, you're going to say, because you guessed or because you had a plan, but you didn't follow it. So we want to learn how to avoid doing that. I think it's important to understand that there's a lot of mythology about trading. Like people think that a guy like Steve Cohen or Mario Gabelli have secret systems, and every stock they buy or trade is always a profit. And it's not. I mean, losses are a part of trading. You can't avoid them. There's, as far as I know, there's never been a trading style in the history of trading that's always profitable. The secret is going back to that psychology. It's getting out of your losers really quickly and letting your winners run. But because of psychology, if we buy something and it goes lower, people want to hold on to it because they don't want to take a loss. And it's even more than the money. It's people, people don't want to think they were wrong. It hurts your ego. This is what we call, I guess the trading community calls it the baggers or whatever. And then when something is going higher, people tend to sell their winners too soon because they get afraid they're going to lose out on their profit. So like in the paper trading world, if you come up with a strategy and it says buy at 10 and sell at 15, it's easy to do. But if you have real money involved, if you bought 1,000 shares at 10 and it's going to 15, well, when it gets to 12, you might say, hey, this is $2,000, man. I better sell this before it ends up going against me. And you sell it, but then it ends up going to 15. So the emotional discipline to be able to let your winners run and get out of your losers quickly is not an easy thing to do, but that really is ultimately what really comes down to the difference between, in a lot of ways, between success and failure. From a trading, if you have a day trading or maybe a swing trading type of style, and that goes back to our psychology, and that's our psychology class. People, when there's a fear of losing money, the fear makes people do irrational things. And that's where we get a lot of our, market moves. Like, for example, if this does get down to here, my suspicion it does, this is like people panicking, right? Throwing in the towel. Like, look at this. This was people panicking. Oh, Ukraine. A week later, that it was much higher. What had changed other than investors' perceptions? So a lot of people look at the market and they think it could be figured out like a chess game, right? Like if you're really smart and you really think it through, you can come up with, some kind of a strategy that always works. But it really isn't a chess game, because in chess, the rules are always the same. The pieces always move the same way. This is more of a poker game because there are rules, but a lot of it is psychology. There are rules, but a lot of it is psychology. There's ultimately a human being somewhere else on the other side of your trade, right? And people do irrational things, and people have emotions, and what works today may not work tomorrow, and what works tomorrow may not work on the next day. Things are always kind of changing because this is a common, this is mass psychology here, and people do irrational things like get scared and sell. Got scared and sold, right before we went higher. So I think if people think about it in the sense that the markets are not completely logical, it makes it easier to kind of understand like what's going on here. So yeah, so I think that's an important takeaway for people, because a lot of people that are interested in trading tend to be intelligent or smarter than average people. And they start to think like, oh, is this a puzzle that I could kind of figure out? If I'm smart enough, I could figure out a secret system that always works. And it can't be done. So don't bother trying. Well, maybe who knows? Maybe it can be done by someone, but it can't be done by people that I've ever known. And I think a good example of this, Rodrigo, is 5 years ago, any fund that had anything to do with artificial intelligence, people are just throwing money at. And now the performance of most of those funds has been abysmal. So it just shows it's not about the math, it's about the psychology.
Right. And a lot of times new traders, Mark, they just kind of get confused with all the noise, right? They get too much information, too much data, and they forget the fundamentals, the basics, right? Because if you can't read a chart, it doesn't matter what you're trading. You're gonna, like, with stocks, you lose money, but with options, you can lose all your money just by not knowing how to read a chart. And it's very easy to overlook it and say, "Oh, I got this." But in real life, it's different. All the thousands of traders I've talked to, and as you as well in the school, dealing with them firsthand. It's just good that you actually cover what matters in the markets, not just the fairy tales, the rainbows, all that stuff.
Yeah, people and I can understand why. There's so much misinformation, there's so much confused information. People in the media just regurgitate what other people said. Like now people are starting to get bearish or all of a sudden everyone's noticed the market's going down. We first got bearish back in November. That's when we first started to see things coming apart. And let me give you a little bit more insight on that, because people are probably thinking like, oh, is this guy lying or what? But I'm not. But I'll show you why we started to get bearish back here. Like around here, November, December, there were a lot of things that were starting to really go down, right? Markets go down at different speeds, or different parts go down at different times. By the time we got to here, November, a lot of the Reddit stocks had completely crashed. I mean, some of them were down 90, 95%. So we had a crash in that part of the market while the broader market moved higher. Then we get into here and things really start coming apart. But what was happening was the stocks people were selling, they were going into the big companies like Apple and Microsoft. So the S&P 500 is 500 stocks, but this big move up here is based probably because of maybe 10 of them, Microsoft, Apple, Amazon. So it disguised the fact that the vast majority of the market was starting to go lower, and the money was going into the kind of the flight to safety stocks, the things that were considered safe, Apple, Microsoft. Now, one of the ways we saw this coming was with this chart here. This particular ETF is the NASDAQ 100, but every stock is equally weighted in it. So you don't have that same dynamic of the bad action being masked by bigger names. And look at where this broke its uptrend in November. So this is where things really started to come apart. So, this market sell-off is not surprising. We've been talking about inflation since the class started in September. It's really kind of unbelievable that in our Benzinga school, trading school, we can see stuff that apparently they can't see at the Federal Reserve.
Yeah, I remember when you called the bottom on oil. I think it was last August at 60, and we hadn't even started the school, and the pre-enrollees at the students, they were already making money with that call, buying the oil stocks.
Yeah, now let me show. That was a pretty easy call, and I'll show you why. So that was here, August, and I remember it was a weekend. All right, so let me just bring this up here, and I want to go back to our discussion about how some price levels are more important than others, and you could see it here. So this is the 6250 level. I'm gonna put it right. All right, so 6250. Actually, going to go a little bit lower. I'm going to just say 62. So this is when we had that whatever that was, the boot camp. Let's see. I don't like these colors they use, so just bear with me for a minute while I make them the way that I like. All right. So this indicator down here is what we call our relative strength index. It measures momentum. Momentum is not volatility. Momentum is how far something has moved in a given period of time. Now, historically, every stock or commodity in this case, or crypto, or whatever it is that you're thinking about trading, has an average or typical trading range. If it gets really beaten up and gets knocked below it, we call it oversold. If it gets really aggressively bought and gets above the range, we call that, I'm sorry, if it gets really aggressively bought and gets above that range, we call that overbought. So that's important because things that are overbought or oversold tend to reverse. So going back to this oil thing here, oh, I'm sorry, when the blue line gets below the red line, that indicates oversold conditions. So if we go back here to May, where did oil find support? Right around 62. So here we have this big sell-off and we get oversold and we get to support and we bounce. Oversold markets that get to support tend to rally or tend to bounce. So that was here, right? So that was the good call that Rodrigo was talking about. Let's go up here now. This is December. We go into this big free fall because this was the Omicron variant news came out. And we go into this big sell-off and we get down here and we get oversold and we get to support and we rally. So for whatever reason, when oil gets to 62, which is kind of hard to believe now, that's around 120, but if oil gets to 62, people, there would be enough buyers that they would put a floor under it. And a lot of times things reverse off of that. So this was a pretty easy, relatively easy call because clear support and we're oversold. And this was pretty easy call too, because it's clear support and we were oversold. So it's just it's the basic fundamentals, Rodrigo. It's not overthinking it. It's just thinking about what levels and trends are important.
Right. And I mean, this is really the fundamentals, Mark, because most people, again, they just get confused with a lot of the stuff that's out there, and it's just easy to get sidetracked. But these 8 chapters, right? Which one do you, well, I mean, they all work together, right? Obviously, none of them work without the investment psychology part. We did touch a little bit up on that, but what do you think is a good example of, because I feel that the psychology part, most people can understand it. Maybe someone here might not understand what is a level or the levels that matter, but might know that feeling of blowing up their account and losing all their money and over a simple emotional mistake.
Yeah. I mean, it happens. It happens. If you trade and you stick to your plan and you accept the fact that you're going to have losses, that's one thing, because Babe Ruth struck out more than any other baseball player, right? If you come into this thinking like, oh, if I don't make $1 million, I'm doing something wrong, that's kind of the wrong mindset. You got to come in here and understand that you don't want to put all your eggs in one basket. And if you really want to learn how to trade, you've got to cover, we also talk about things like risk management, how to position your portfolio, like how many stocks do you trade? Like some of the students are open to pretty much trading anything. Other students just stick to a few particular names or sectors. Like we have some people that all they do is trade the Qs, the S triple Q, and then the T triple Qs. We have to understand too about the best way to allocate our capital. Like what's the best way to get bang for the buck? Like, for example, this here represents the technology sector, this spider. I guess I should. The S&P consists of 11 sectors, and this is one of them. This ETF follows the technology sector. Now we get down here and we do get the bounce like I was talking about. This will go up, say, I don't know, 3, 4, or 5%. But within this sector, there are probably stocks that will go up much more. So we use the sector ETF as like a map, right? But if it starts to look like it's going to go our right way, if this moves 2%, there might be stocks that move 10%. So part of trading too is not just understanding the market and understanding trading models and understanding psychology. It's understanding how to get the best bang for your buck. Like, what's your most efficient use of capital? So there's a whole, I guess we covered pretty much the whole gambit, I guess you could say. Yeah, so what psychology, most efficient way to use your capital. A lot of people are learning about options. So yeah, Rodrigo, we've been, I'm glad people have done really well over these last few months here. Because, I mean, like I said, it's been a fairly easy market to trade. And, now we're breaking what looks to me like another clear support level. So I would not be surprised to get down to here over the next few days.
That's the beautiful thing about the school, Mark, where you teach people how to think for themselves, right? It's not like, this is entry, exit, like some sort of high frequency trading group, where it's like, we want to teach you how to be able to find these opportunities on your own. And also because a lot of people in the trading school, they're doing this to make real income. Not everybody's gambling out there, right? So you have people that are serious about creating income for this, either because, maybe the situation right now, or maybe, their work is limited, right? So that's the thing, man. It's good that you're teaching them how to do this on their own and guiding them instead of just throwing stuff out there, and like hope they catch on.
Yeah, I mean, I don't have all the answers. I'm not perfect about where the market's going, and everyone has a different personality, and everyone looks at things a little bit differently. So, I don't want to have this like the only prerequisite to be in the school is you got to want to learn. I don't want people that just think, oh, what's our trade idea of the day, and if something doesn't work out, they don't. I mean, like you could take guitar lessons, right? But you're always going to play the guitar the way that's your personality. You can't just like try to play the way your teacher plays. Um, so yeah, there's no like one size fits all. So that's why I think it's kind of like silly when you see these people that are like, oh, watch how I trade or watch what I do. I mean, like you could watch Rory McIlroy in a golf ball. Doesn't mean that you're going to be able to hit it like him just because you watched him. So yes, it's a school, and there's a lot of interaction. There's a really strong community. A lot of the people are becoming friends. We had a great time out in Vegas. People are working on different study things together. So yeah, it's a school, man. It's like learn how to think for yourself. Learn how to fish for yourself. So yeah, that's why that's one of the reasons why I think people like it. It's interactive, I guess. Interactive learning. All right, so we got some real weakness here in tech, and it looks like this could keep rolling. And it's really unbelievable how bad stuff has really just started to come apart over the last few days or week. I mean, if you consider the fact that our interest rates are up 10% in 5 days, the bond market is in a complete meltdown. I mean, I've never seen times like this before in my career. Well, I mean, I've seen bad stuff happen before, but this kind of almost seems all pretty much self-induced because of our energy policy that drove oil prices up so high. Because energy bleeds through to everything, and they're trying to make now they're trying to make ExxonMobil the scapegoat, and that's just so juvenile. 80,000 people work for ExxonMobil. You're telling me that they're all in profiteering? They have to drive to work too. So anyway, it's pretty bizarre, but it is what it is. We just got to watch the market and figure out how we can make money on it. But what I mean, when I say I've never seen anything like this, I don't think I've ever seen the staggering incompetence in some of our leaders. Like going back to our Powell example, Powell was wrong about inflation. He was saying it was transitory. As of November, as of right here, he was talking about how great things are. The guy yesterday says he doesn't see any signs of a downturn on the same day that part of the bank comes out and says, we're cutting our growth from 9 or 0.9 to 0. So that doesn't leave me with much confidence. I don't know why this guy is still even in charge. And here's the reason why they're so wrong, right? We bring up our little slideshow here. This is we have every week I do a little newsletter. And this is this week's, where we just talk a little bit about it. It's an educational thing, right? It's a school. So talk about the Zimbabwe inflation. I don't think anything like this is ever going to happen. But we go into some of these former Fed chairs that have really messed up. And, Greenspan held rates for too low for too long. He held rates for too low for too long. He's holding rates too low for too long. Now, here's the reason why. They follow the Keynesian school of economics, or Keynesian. And the Keynesian school just really focuses on the demand side. It doesn't really pay attention to supply side. Now, what I mean by that is they're just looking at the consumer and they think, oh, interest rates are going up. Oh, that's got to be good. Or inflation's going up. That's got to be good. That's a sign that the consumer is buying stuff. Inflation is good. But the problem is that the inflation that we have now is driven by monetary policy. We can go back to here, right? Monetary policy. So this is why they put too much money in the economy, because they don't pay attention to the money supply. And that's the reason why we have this inflation. One is the energy policy, and two is they printed too much money. But the reason why, if you want to know, you might be sitting there thinking like, oh, gee, well, if this stuff is all so obvious, then why didn't Powell see it? And that's the reason, is because they follow this Keynesian economics. They don't pay enough attention to the money supply. So this is just the newsletter. And you can see, right? This is what is today? Thursday, yeah. So notice how I have a bear, right? Sign the market's going to go down. If these levels start to break, look out below. So I wrote this on Sunday. So these moves are not surprising me. We talked about the bond market, which this is totally happening. Oil hasn't broken out yet, but I think there's a chance that it does. But going back to our levels, right? More than 70% of the market, these sectors, there's 11 sectors in the S&P, 70% of the market was on clear support. And we broke. Here's the tech sector, clear support. Apple, healthcare, clear support. Financials, materials, industrials, communication services. So this move down is not surprising. We haven't broken out in oil yet, but I think it probably will. So this is just proof here, Rodrigo, that just by watching these important levels, is what gives you the insight into what's happening in the market. This move down is not a surprise to any of us in the school.
Right. And that's the thing. Some people might just stare at CNBC all day and they're losing money and they're like, gee, why? Why is this happening? I should be making money if I'm watching this all day, right?
Yeah. Well, I think that CNBC probably has lost more money for people than Madoff and Ponzi combined. But yeah, they just have a lot of people that I don't think they know what they're talking about. I can guarantee you this, right? As someone who spent 20 years working on trading desks of institutional hedge funds and money managers, I can tell you this: no one is watching CNBC trading off what they're saying. Like if one of these guys on CNBC comes out and says like, oh, the market's down because of this. It's not like everyone is like, oh, let's sell. I mean, I would never even let people put CNBC on my trading desk, because I just couldn't take it. It's like torture. But yeah, they spread a lot of misinformation. Maybe a lot of the people mean well, but they don't have the experience that I do, or their background is in journalism, so they don't really understand how trading is working. So now people are going to come out and say like, oh, well, the market's making this big move down because of this, because of that, or because of the other thing. Well, I would argue that the market makes big moves down when support levels break. I mean, what comes first, the chicken or the egg? I don't know. But when at the end of the day, I'm always going to go to the chart, because the charts don't lie. Charts don't have opinions. So, we held up for the last 3 days, and now it looks like we're ready to get another leg lower going on here. So when people say, well, why was the market down? My answer would be like, well, we broke important support in the technology sector, right? Resistance becomes support, then the market memory stays intact. So, if someone was to ask me right now, Mark, why is the market down so much? I guess I could say, well, there's all this bad news going on, but my initial answer would be like, well, we broke important support in the tech sector. That's why we're heading lower right now. So that would be my answer. So we let the market tell us what to do. And when the market breaks important levels, then it's telling us something. So to me, the fact that this support is breaking is telling me that the market's saying, hey, man, I'm about to take another leg lower here. And the financial sector looks kind of similar too. So breaking an important price level, and it looks like we got some room to move on the downside. So this is telling me, hey, this looks pretty darn weak as well. So we're not guessing. We're not saying, oh, it's down 20%, it's time to buy, or it feels like it's time to buy. We'll know when it's time to buy, because we'll see all this stuff starting to bounce off of support levels. Right now, the support's breaking. But when that bottom comes, Rodrigo, we'll know. We'll know, just like we knew where the top was, because when you watch the market every day, you just start certain things. If you know the right things to watch, certain things start to become pretty self-evident. And if we get down to here and we get down to that support level that we talked about in the technology sector, then you got two important sectors at support, oversold. If they each start to bounce, that's going to bring the market higher. And it's because of a technical bounce. It's not because of whatever the news du jour is that day, Rodrigo, right?
Like, people right now are making a ton of like emotional decisions. I think everybody with their trading, and ultimately kind of just sitting down, going through the charts with you, it just brings, from what I hear from the students, it puts them at ease, and it just something that many new traders might struggle with, right? Whenever things get too violent, right, either on the bullish side or the bearish side, people tend to get very emotional around those times.
Yeah, I mean, think about it. If people didn't have emotions, markets would go in straight lines. But, euphoria, fear, euphoria, fear, euphoria, fear, euphoria, fear. You have to understand, so much of this is just due to investor perceptions. There's not, most of the time, there's not a reason why something is moving that can be explained from a fundamental point of view. And that's the problem with the media. They always try to do that. You have to understand that markets are irrational because all this is a list of transactions between people, and people do irrational things. So now I forgot what I was saying there. But yeah, people do irrational things, and people are getting emotional. And now we're going to start to see, I think, people are going to start to look at their 401k plans and be like, why am I down so much? That's another problem that the economy has too, is the wealth effect. People are going to start seeing how much their retirement accounts and their savings are down, and then they're going to stop spending money. And, Powell came out yesterday and said, I don't know if it was Powell, but one of these guys said, oh, like the consumer is still strong. And it's like, I mean, retail sales came in below estimates. They were actually negative. Walmart, we see is building inventory, which means they're not selling stuff. We had this massive move higher in inflation in a mortgage. I mean, if you have an adjustable mortgage, you're going to be in a lot of trouble, frankly. So I don't know, maybe that's something you can think about, a way to protect yourself. But just to reiterate for those of you who joined a little bit later, this is news that came out today. And since last week, now I'm saying last week, 7 days ago, rates have gone from 5.23 to 5.78. So people are going to start, it's going to start spreading, and then people start to capitulate. People start to think like, oh, it's going to go lower, and it becomes a panic. Let me go back here and I'll show you how back in March of 20, at the place I worked for before Benzinga, I was writing about how it was the bottom in March of 20 when everyone was freaking out because this was the whole COVID crash. But I'll show you what I was looking at. All right, so everyone's freaking out. Is the world coming to an end? Markets crashing, so forth and so on. What did I do? Well, I just happened to look back into 2018 and said, hey, maybe there's a chance this is the bottom. Maybe if this holds, we get the rally, and that's the bottom. And sure enough, that's what happened. Now, I didn't figure this out with a magical crystal ball or anything like that. I just looked into the past and saw, hey, we've reached a level that was important before. Then we break our downtrend, and that's the time to buy. Got to a former level, that's important. We broke the downtrend line, and the rest is history. The market just took off from there. So this is something I wrote about, and so it's published. It's not, I'm not making it up. But you have to remember, in the context of this time, how people were freaking out. The world was going to come to an end, this, that, the other thing. But I didn't listen to all the pundits. I just watched what the market was telling me. And it started to say, hey, Mark, it looks like I'm going to hang out at this support for a while. Maybe I'm not going to break through. Oh, hey, Mark, I just broke my downtrend line. Maybe I'm going to start to go higher. Oh, hey, Mark, let's start moving higher. And sure enough, that's what happened. And now we can see another example of an important level here, which I wrote about a lot when I was at that place. 323. So this was the last area of trading, or the last area of support before the COVID meltdown started. So this is January of 20, and this is 323. So we sell off. Look at where we hit resistance on the way up, right here. What was support turned into resistance. Then we move forward in time, and we spend a few weeks trading around that level. Resistance becomes support. Support stays intact. So for whatever reason, 323 is an important level for the spider. Now, here's something that's going to amaze you and maybe freak you out a little bit. This is weird how this stuff happens, but since 1929, okay, there have been 25 bear markets. Bear market is defined as a move of down more than 20% from its top, right? So there's been 25. The average loss has been 35%. Market goes down 35%. Now, our peak was at 480. If we were to go down 35%, like the average bear market, where does that put us? coincidentally or not coincidentally, right down to where this important level is, this 323 level. So, you know, if things keep going lower and keep going lower, there's a chance that we can get down to here again. That would be the historical norm for us to get down to around here. And frankly, it's looking like it could happen. And people are spoiled because, well, a lot of the younger traders are spoiled because, you know, they came up in the great bull market of the, I guess, the 20 teens, you could call it. And they never saw a bad market. Now, this here is the Dow Jones going back to 1897. And this chart dispels the myth of buy and hold. You can see the recent sell-off, or the current sell-off, I should say, is kind of just starting to really show up. But to dispel this buy and hold myth, and you look at this here, right? The Dow Jones got to 1,000 in January of 66. It didn't break through until 1982. So in this era, buy and hold was not good. You know, up here, buy and hold good. Here, buy and hold not good. So the reason why I'm showing you guys this chart is because I just want you to understand that these market sell-offs can go on for longer than people think. So don't expect it to bounce back anytime soon. And even if we have the capitulation, we're gonna rally, but we're gonna roll over, I think, and continue to drift lower. But there, you know, there's going to be a tradable rally pretty soon. But I still think we can go lower. You have to remember when we had the capitulation in March of 20, Rodrigo, it was a different time. You know, we didn't have inflation then. So now, you know, things have changed. So it's unfortunate, but it is what it is. So I think next stop on SPY, we could get down to about 356. And, you know, this sell-off is accelerating here as we get into as we move closer to the close. So a lot of times you get really big moves that start, whatever the trend is during the day starts to really accelerate around 3 or 330. So between now and the close, you know, we could move considerably lower. But yeah.
Right. I mean, most traders, like you said, you know, they're not used to these markets, you know, including myself, right? You know, and you'll find yourself catching bottoms just following, you know, the headlines and things like that. But it's really an agnostic approach of yours, right?
Yeah. We let the market tell us what to do. And the market's telling us, hey, looks to me like I can get to 356. And the reason why I say that is I don't see anything clear over here. You know, this to me was like a clear support level. So that's where we stopped. You know, this looks like a pretty clear level. I don't see anything in here that looks clear. So, you know, obviously it's not a guarantee, but my guess is that we could keep moving lower, man, until we get down to there. And if we do, then that's when we start thinking about playing a bounce. So we had nailed this 370 level here. And I know a bunch of the students got this, made some money off of that. When we got down to here on this particular day, the low trade was right at 370. And that's because if we go back here, that's where the low trade was. So I just can't emphasize enough how important it is to understand where these price levels are and that important price levels are. And if you can do that, you will be so far ahead of the game versus other people who don't understand this that it's almost going to be like laughable. But yeah, so that's the story. It's like we you know, I see people out there that they're like, oh, like we're like warrior traders or champion traders or ninja traders. You know, this is a school and we are students of the market and we let the market tell us what to do. At least that's the mindset I like to keep. Because I don't like the whole concept of warrior trading because you're not really fighting the market, right? I mean, you know, you want to be on the same side as the market. Like I just don't like that mindset. Like, oh, we're warriors, we're gonna kick some ass, you know, or ninja traders. you know, because to me, that just kind of implies like ninjas are secretive. And I don't think there is a secret. You know, it's all the stuff I'm talking about is how people get successful. Or people that are like, oh, I'm a champion trader. I don't like that either, because that implies that you're competing against other people. What we are is we're students of the market, and in being that, we let the market tell us what to do. And right now the market is saying, hey, I might go considerably lower. So that, I think, is the take that people like there, Rodrigo.
Right. And no, as far as the trading school, you do a lot of teaching there, Mark. You go through lessons, chapters, you dig with the users, right? With the actual students into what's happening with their trading.
Yeah,
But
some of the best ideas we've had have come from the students.
maybe we can show them the your live trading room, because you do have a live trading room for those that didn't know.
All right, so should I give you the screen back?
I mean, I can put it here, but if you can put it
Yeah,
there.
let me give it back to you, because I want to go get myself a glass of water.
All right, 1 second.
All right, I'll be back in like a minute.
Okay, all right, I'll see you here in a bit. All right, so Mark's coming back here, folks. But for those of you guys in Twitter that want to join the trading school, it's a great experience. You should try it. You got classes Monday to Friday. And on top of that, you have Mark's live trading room and Benzinga Pro, which is our proprietary market research terminal for all stocks, all news, all that sort of stuff, options, that, you know, all that. So there is a 7-day trial if you want to give it a shot. If you want to keep it after that, it's $14.97 for the year. And you do get a free laptop. So we're trying to be a little extra nice. But let me show you the chat room really quick. 1 second. Where Mark is posting all his trades. All right, so I think this is it. Yeah. Okay, so you have the video library where you find all the recordings of the classes. You have the live. This is when Mark is live in the. Let me go back. I clicked it. So when you have classes, which is Monday to Thursday, 7 to 9 a.m. and 12 to 1, everything Eastern, you're going to click live here. It's going to take you to this session where you have the live class, right? All the students there you have your chat room for the live class. And this is where Mark is going to be, right? Then if you want the recordings, if you miss it, you just go to video library. It's on the top. Everything's on the header. So that's where you get the recordings on video library. And if you want to do live trading, you click on chat. I'll show you. And you have quizzes here from Mark. You have Mark's trade ideas as well. So basically you can find, you know, Mark's entries, exits, commentaries on stocks. There's a really interesting one here that I did here. What is this? There you go. I mean, you're seeing all of it play out pretty much. So this is basically where you can see all the charts have a specific level notated, right? I mean, just as an example, I mean, they all have levels, right? But, you know, picking whichever one randomly. Like crude oil, Mark calling a reversal there on oil. It's a pretty bold call there, my friend. Pretty bold there, Mark. What do you have to say here? I think we have Mark back, by the way.
Yeah, I'm back. What were you talking about there?
Yeah, so this is an oil reversal that you called.
I don't even remember that.
This was. Ooh, it was a while back. Well, damn, I can't. There's a lot of stuff. Okay, so this was on Feb. Well, damn. So yeah, I mean, this is just it's a lot. You're putting a lot of trade ideas here.
Yeah, and there's also students put ideas in there too. You'll see there's like a student chart of the day.
Student chart. Okay, so what is the student chart of the day, and how can students use this? Part like trading school members, how can they use this to improve their skills, and not just in charting, but overall?
Well, I kind of stay out of that chat room. I think that that's for students to just post stuff and to communicate with each other. And it's picking up some momentum now, but that's kind of something that I want to stay away from. That's really, like, I mean, obviously if someone has a question, I'm going to answer them, but that's really more for like the students to kind of interact and share ideas and talk about what they've been learning. So that's what that is. So that's
Okay.
that's a pretty new feature. We just added that like a week ago.
Okay, so that's a new chat. All right. Now, student plan project chat, there's developing a trading model or something like that.
Yeah. That's something I don't really get into either. Oh, let's see. Question for me.
Questions for Mark. So this is another chat room called, and I assume this is for people that maybe cannot attend the live classes and might have questions for you after.
Oh yeah. See that the student there, Andrew UK, he lives in Britain, and he was asking about the whole thing with the bear market. So he was a little confused because I don't think it's an official definition, but it's just kind of accepted that if the market falls by more than 20%, that's considered a bear market. But that's what I was just talking about here, is that if this ends up being your average bear market and SPY goes down 35%, geez, this thing is just in a free fall. And the SPY goes down 35%, it could get us down to around 310 or 320. And my guess is we stop at 323 because that level was important, which we just looked at before. So yeah, so I think
so since we've been doing this, we've been talking about the markets dropping. I went ahead and actually traded a little bit of the SQQQ calls, but I'm out of it. The market's been tanking. Can you take a look at that?
yeah, well, this is going to go higher as the market goes lower. So, we're really starting to see the bloodbath here in tech. So, I mean, if you were long this, you'd be up 14% today. Or you said you bought calls?
Well, yeah, I bought calls while we were talking about it here. We've been here for about more than an hour, but I bought it like as we were doing this stuff, doing some trades.
Are you going to sell them?
Yes, in a little bit.
Okay. All right. So this is the 1-day chart. Yeah. Let me go back here. So that is based off of this. The Qs.
Can you share your screen there, Mark? I don't think
Oh
we
yeah,
should
I guess that would help.
Yeah, great call there, by the way, man. It's like, even during these sessions, I mean, can you just imagine, like, doing this live? I mean, we do this live, I mean, with the students every day, right?
Yeah, pretty much just like we're doing now. Yeah, I mean, this I think this is the largest stocks in the NASDAQ that don't include financials. But let's just go look over here at our tech sector, because that's ultimately going to follow it. Yeah, I mean, this is, we're down 4.7% now. But things are really just coming apart at the seams over the last, as bad as things have looked, like I said, we really started to see things start to come apart back here. As bad as things have looked, they've gotten even worse really fast. And all right, so let me just see what we can talk about here. All right, so now to add to the list, we got this mortgage news, the biggest 1-week move in history. So can you imagine if you have a floating mortgage, like all of a sudden you're going to have so much more money that's got to go to your mortgage, that's stuff that's going to come out of the economy. So we got that. We got, the Federal Reserve in Atlanta going to 0% growth prediction, which has got to be worse. You have Jamie Dimon saying, we're going to have an economic hurricane. And, Jamie Dimon is, I saw a lot of people say, well, his economists don't even think that. Well, Jamie Dimon is not an economist. He runs the bank. So he's got access to seeing what's going on in people's accounts. He talks to investment bankers. What are they seeing? So this is a guy who is got his finger on the pulse. And when he says we're having an economic hurricane, we got that. We got the head of the EIA, the International or the IEA, sorry, the International Energy Association, saying that we're going to have fuel shortages this summer that are going to be like the 70s. There's this story, let me see if I can find it. I mean, I'll be able to find it, that no one has talked about, that I've heard, which is pretty amazing, frankly, but I guess not surprising. But when we talk about like the S&P 500 and so forth, well, this company maintains these indices. But one of the things they also do is they go around and they rate companies. They rate companies for their debt. Like if you see a bond that's got a AAA rating, the odds are very small that that bond is going to default. If you see a bond that's got like a C rating, that might be considered high yield or high risk bond. So that's what these guys do. Now, most companies, they don't take their money like from the cash register to pay their employees, right? Most companies have to have these revolving lines of credit. They borrow in the overnight markets and so forth and so on. So because they need to get a line of credit, they get rated by a place like S&P. There's also Moody's and Fitch are the other two rating agencies. So this is a publicly traded company that has to report its earnings. Basically, what they're saying is stuff is so messed up that they're going to withdraw their guidance. They have no idea what's going on. And if we look here, debt volumes have been extraordinarily weak here to date. That means companies are borrowing less money for their overnight operations. Things are really slowing down. They don't need the money like they did before. Should similar trends continue through the end of the year, we could see declines of 30, 35%, 40%, which is a nice way of saying we're going to see the business slow down by 30 or 35% or 40. So this is a really concerning story here, and no one seems to really be talking about it. So this is another thing that we keyed up on. And when did this come out? So this came out on June 1st. So this is yet another reason why we were bullish, or I'm sorry, bearish. So that came out like right here, June 1st. So put it this way, there's nothing to be bullish about right now. Maybe sentiment is getting to the point where it's getting so negative, we're going to get some kind of a bounce. But, we have the economy is just coming to a screeching halt, and it's energy prices, price of diesel is going higher. And even from a historical point of view, based on valuations, we could still go lower based on valuations. We're still overvalued. So yeah, it's not a pretty scene, Rodrigo, but it is what it is. What else? There's nothing we could really do to change it.
Well, I think that as traders, the one thing we can do is find ways to not, we can make money during these times if you learn how to trade and all these things instead of just sitting on the sidelines. You can do something about it. Just by having your money sitting down, it's losing on inflation as it is. So if you stay still, you're losing, right? You have to find something right now.
Yeah, and like I said before, when we first got started, I'm just surprised at how many so-called experts are saying go to cash because they think the market's going to go lower. And if you think the market's going to go lower, why would you go to cash? Why wouldn't you just buy one of these inverse ETFs? You wouldn't want to maybe not get really leveraged up with the SQQs, but like something like this here that's just trades opposite to the S&P 500. So I don't think going to cash is I don't think going to cash is your best option. instead of going to cash, I would park some of this in my account here. You know, it's not leverage, so you know, you're not going to get the really big moves like you would with one of the leverage ones. But you know, I don't understand it. I don't understand why I see all these pundits on TV say go to cash. It's almost like they don't even know that these adverse ETFs exist, Rodrigo. So I'm pretty surprising to see that over the last few days. And also with the whole
Yeah, yeah,
sorry,
sorry, I was muted there, my bad. But I was gonna say, we've been here for, several hours now here, folks. So if you do want to join Mark Petrino live, right, not just for learning, but for trading, right, be part of a community, something bigger than yourself, learn with us, trade with us, and just be part of this community. It's great. Give this a shot. You have a 7-day trial. It's $7. If you want to keep it, it's $14.97 for the year, and you get our research terminal platform, Benzinga Pro. But Mark, what would you leave here the folks here with when it comes to trading? Just what to be careful in this markets and why they should be getting into the school, right? Especially in these next days.
Well, these are the type of markets that traders kind of live for. You know, we want the volatility. I mean, it sucks that the market's going down, right? But for a trader, this is the type of market you want, because we have these clear, well-defined levels. We have big moves. But what I would tell people who are listening right now is that, you don't need to be afraid of these things. I mean, it's obviously it's not good, but there are ways you can protect yourself and even make money from inflation, like we saw with that DVC ETF. There are ways you can make money when the market goes down, like we saw with these inverse ETFs. And it's not complicated. You can buy SH just like you buy a regular stock. It's not a complicated derivative strategy or anything like that, or option strategy. It trades just like a regular stock. So if you think the market's going to continue to go down, this is something that you could consider buying. So don't, none of this like go to cash or put your head in the sand and hope it goes away. These are markets where when other people are afraid, it's time, these are times where we can really benefit. And I would also say too, that if things keep going lower, I think when we're at the bottom, it's going to be pretty clear. It's going to be pretty obvious. I don't know if that's going to be tomorrow or if that's going to be in a month. But it's going to be, we're going to see it when it's happening. So, it's always a good time to join the school, but now is a gooder time than other times. So that's what I would leave it with there. You're muted, Rodrigo, if you're there.
Yeah, no, sorry about that. So, folks, yeah, definitely a big shout out here. Mark Putrino, lead trader and educator at the Benzinga Option School and former hedge fund trader, traded with Mario Gabelli, Steve Cohen, multi-billionaires out there. So big shout out and thanks there, Mark, for everything you do there, for the students day in, day out. Let's go, Mark.
All right. Thanks a lot, Rodrigo. So I get to step out now because I can see stuff going into the close. But I guess if you're going to hang around for some questions, I guess that would be good if people have any follow-up questions. But all right, so I appreciate it, Rodrigo. I guess I'll check you out tomorrow morning in the class.
Yeah, I'll see you in the school, man. And thanks for looking up for ACOR for all these folks here that wanted to that. They say thank you big time. Shout out.
Okay, you're welcome.
All right. Okay,
all right, see you later.
All right, really quick. I'm only going to be here for a couple minutes. I'm just going to show you this stuff. So the chat room, you have all the stuff here. Student chart of the day, where everybody shares trade ideas. Student plan, project chat, Mark's trade ideas, where he's posting entries, exits, supports, all that stuff. Weekly previews, right? He does this once a week. Let me show it to you. Pretty much going over the markets, what's happening with different stocks and symbols, and he goes over each one of those, right? Then you have live, if you want to look at the live class, video library for the recordings, Benzinga Pro. If you do want to look at your Benzinga Pro, it's a market research tool that we use here. It's proprietary to Benzinga. So if you're familiar with Bloomberg Terminal, this is like 10 times better. and it's for retail traders, mostly because it's so customizable, right? So news driven and really adjustable, right, to what you're doing, not just the news you're looking for, but organizing your stocks and keeping the right data in front of you for that. So if you want to join on Twitter, click on that link. It's $7 for 7 days. That's your trial. If you want to keep it, it's $14.97 for the year. You get the laptop pro and the school. And if you're on YouTube, you're going to see it on the chat. And we'll put the email if you want to email for any questions and such. But thanks a lot, folks. Thanks for being here. We'll see you next time. Big shout out to all you guys. And we'll see you guys in the school.